2 years ago that I sent around a community question asking whether the level of inflation was temporary or not. And this was back when the Bank of England had said sorry for the cost of living increases, and its expectation was that CPI would peak at 5% in April 22. Clearly that was way off when the inflation number actually hit 7%, the highest since 1992, and roll on to today, and the CPI stands at 4.6% and our old friend RPI at 6.1%. The official bank rate, which was just 1% back in May 22, now stands at 5.25%, and we can suddenly get a rate of return on our cash. And this finds us possibly towards the latter stages of a transitional phase where both consumers and asset classes are having to readjust from a low inflationary, low interest rate one to a high inflationary, high interest rate world, which has had repercussions for both assets and consumers. One of those areas has been a significant increase in the number of individuals that are all of a sudden being pushed into higher rate tax bands, and in addition, I want to consider the somewhat bizarre impact that the removal of the lifetime allowance and freezing of the maximum tax-free cash might have on individuals when considering their pension planning. A big part of this is fiscal drag, the somewhat sneaky way of leaving tax thresholds in place, otherwise as mentioned before by someone as the big freeze, in which inflation will drive prices higher, wages higher, but tax thresholds are left in place. We know that Jeremy Hunt has put a freeze on the various thresholds until 2028, and half a decade is a considerable length of time when you consider that inflation is currently where it's at, or higher depending on your own inflation number. So very broadly speaking, these are the personal allowance, takes you up to 12,570, the basic rate band, which takes you up to 50,270, and then the higher rate band from 50,270. We then have all kinds of issues at £100,000 plus with reductions in personal allowance, and then you've got the additional rate tax at 45% from 125,140. An obvious example of this is that we will likely see many of those in receipt of the state pension having to pay tax on it for the very first time, with the likely increase from April 24 being around 8.5%. This would take someone on the full new state pension to an £11,500. Any further taxable income will take them into basic rate tax. And if we just take a look at the government's own numbers on this, we can see that there is about an 8% increase in the numbers paying basic rate tax at 20%, but a huge jump in the number of higher rate taxpayers, an increase of 40% from the tax year 2021 to 23-24, showing the impact of leaving those bands frozen. Even more profound is the 100% increase in the number of individuals paying additional rate tax. So that's tax at 45%. And this is largely due to the lowering of the threshold from 150,000 to 125,000. And so we are seeing more, and we will continue to see more individuals being pushed into higher tax bands, which is wonderful for the Chancellor as he can simply leave thresholds as they are and more tax revenue is raised. By way of an example, the capital gains tax-free allowance is currently £6,000 for the tax year 23-24, dropping to £3,000 from next tax year, meaning an additional £1.6 billion in tax over the next 5 years. This is even more pronounced with the reduction in the dividend allowance to £500 in the next tax year, with the government projecting an additional £3 billion over 5 years. What is interesting is that the freezing of certain bands creates other unusual occurrences that require further consideration. For example, the standard position in relation to the tax-free cash available within a pension is to balance it out over the course of retirement, balance out payments from it, to make the most tax-efficient use of it in line with your other taxable income. It isn't just to take it out as soon as you can and leave it sitting in cash. However, where someone is in the very fortunate position of having reached the maximum available tax-free cash, which is 268,270, as a reminder, the Chancellor has capped the maximum amount of tax-free cash at this level, so someone cannot, unless they have existing protections in place, take more than that amount as tax-free cash. What in effect is therefore the case is that the tax-free cash cannot grow any higher than 268,275, and in real terms, adjusted for inflation, is declining in purchasing power. So for someone in this position where they cannot grow their tax-free cash any further, there is now a reasonably strong argument to take out the tax-free cash, which they can do from age 55 or going up to 57 from 2028, and then use alternative tax shelters to continue to ideally grow that money free of tax. The key here is what the driver is. Is it that some point in the future the tax-free cash will be required and spent, or is the pension being used as a way of passing on assets outside of the estate for inheritance tax purposes? Arguably, if the money is to be spent, then allocating it over a period of time to an ISA could make sense. The combination of ISA and remaining taxable pension could then be used over the years as a valuable source of flexible retirement income. Clearly, any amendments that could be made to inheritance tax could also have an impact on this decision. And as we all know by now, one of the most tax efficient ways to save and invest is via a pension. And as a reminder, it's useful to look at the income tax benefit to saving into a pension. And the simple equation here is what is the tax position of the money going into the pension and what is the likely tax position on exiting the pension. The two income tax factors that make the pension so valuable is the tax relief given upfront on contributions, which then can assist in lowering taxable income to below tax thresholds, and the 25% tax-free cash available when exiting the pension. For a basic rate taxpayer paying in, they'll obviously get basic rate tax relief, and then on exiting, they'll get 25% of that fund tax-free, and then the remaining 75% is then taxed at 20%. So they are in a better position just in terms of the tax. Now, clearly, if someone is a basic rate taxpayer and they're paying into their pension, and then when they exit the pension, they're paying tax at 40%, then obviously they're going to be in a worse off position just purely thinking about the income tax rate. If you're a 45% additional rate taxpayer and you're paying into pension and you can exit the pension and only pay 20% income tax, then you're in a very, very nice position. Now, this does change slightly when you've hit the maximum level of tax-free cash that is available, because clearly you can't have any more tax-free cash from those contributions that are going in beyond that point. So beyond £268,275 of pension commencement lump sum or tax-free cash, you cannot get any more unless you have any kind of transitional protections in place. So clearly there is a point at which it then becomes fairly neutral as far as the benefit, the tax benefit of making those contributions into pension. But obviously this is a more complex equation to this, but it was just to give you an example of what that looks like as far as the income tax position going in and income tax position coming out, and what needs to be considered when we're looking at pension contributions. Potentially, contributions can assist in lowering your adjusted income to specific thresholds. The obvious two would be at £50,000 for those that are in receipt of child benefit, and £100,000 as the personal allowance is gradually lost for income above this level. This is all combined with higher interest rates, in which we are now seeing a return on cash, and this is adding extra savings income on top of taxable earnings. As a reminder, the tax-free allowance and savings interest is set at £1,000 for basic rate taxpayers and decreases to £500 for higher rate taxpayers. The focus will always come back to maximising the use of your available allowances where you can. Primarily, these will be available via pensions and ISAs, but being mindful of your tax position and tax objectives once you've hit the maximum allowable tax-free cash. Looking to use the allowance of your spouse where you can make sense to transfer assets either for income tax or capital gains tax purposes, and will likely all be impacted as more and more of our income is caught by fiscal drag and inflation. Thanks so much for watching, and hopefully see you again soon. Bye.